Did you know that 95% of people who start trading lose their money and leave this field forever? The reason is simple. Most beginners make the same mistakes without even realizing it. But what if I told you that these mistakes can be uncovered and learned to prevent before they start costing you money? In this video, we'll analyze 5 of the most common mistakes beginner traders make and show you how to avoid them. You'll be surprised how often traders make the same mistakes over and over again, even though they are easy to avoid. By analyzing each of them, you prepare yourself in advance for what may happen and get ready-made solutions now. Remember, it is always better to learn from other people's failures than from your own. But that's not all. We will discuss one key point that beginners usually overlook. Because of this, their deposit and self-confidence suffer. That's why it's so important to break down all the details, from basic theory to practical experience. So let's analyze what prevents most beginners from making their first confident steps in the market. The first and most common mistake is trading without a plan and strategy. Many people associate trading with fast money, and it creates a false sense of ease. Many people who come to the market ask themselves, when and how do I open a trade? If you are asking this question, it is already a good sign. It means that you are thinking about your actions. But unfortunately, many beginners do not even do this. Often traders start trading on intuition, following emotions, or even worse, hoping for luck. They may see that the price is rising and open a trade to buy, thinking that if the price is rising, it will continue to rise, or sell when they see a fall, without analyzing the reasons. This is like playing a casino game, where the outcome of events is completely random. Trading without a strategy deprives you of structure. You do not know where to enter the market, where to exit, or how to manage risks. Such actions often lead to a complete loss of capital. To avoid this, develop your trading strategy and plan. Your trading plan should be clear, detailed, and focused on long-term results. To keep your rules always in mind, you can write your plan on paper and stick it next to your monitor. Every trade you open should strictly follow this plan. What should definitely be in your trading plan? 1. Criteria for entering a trade. Determine under what conditions you will open a trade. It can be certain price levels, signals from indicators, or patterns on the chart. 2. Rules for exiting a trade. It is necessary to clearly understand when to close a position. It can be reaching the target profit level or activating a stop loss to limit losses. 3. Risk for each trade. Determine the maximum amount you are willing to lose in one trade. As a rule, it is 1 to 2% of your deposit. This point will help you avoid catastrophic losses. 4. Profit and loss goals. Set clear levels at which you fix profits and limits on the losses you're willing to accept. Even if the plan is not perfect at the beginning, you can adjust and improve it with experience. But if you don't have any plan, you are likely to lose your deposit sooner or later. The next mistake that almost all beginners face is not having a stop loss. This is actually more of a psychological mistake. Nobody wants to accept losses, especially at the initial stage. Opening a trade, many traders may remove the stop loss when the price goes against them, or move it further, hoping that the market will turn around and their position will become profitable. But more often, it leads to even bigger losses. It's all about our perception. We tend to perceive the activation of a stop loss as a loss, like we did something wrong. But in reality, a stop loss is not a failure, but a tool to protect your deposit. Instead of seeing stop loss as something negative, start thinking of it as an insurance policy for your account. After all, trading is a game of probabilities, and no one can always win. The longer you stay in the market, thanks to loss control, the more chances you have to capitalize on successful trades. Your time in the market increases your visibility and understanding of its dynamics, and this in turn improves your trading. Example, trading with and without a stop loss. If you don't set a stop loss, one bad trade can quickly wipe out a significant amount of your capital. For example, you risked $100, but hoping for a reversal, you stayed in the trade. And instead of $100, you lost $500. Now imagine that you set a stop loss that limits your losses at $100. You lost that $100, but you saved the bulk of your deposit for other trades that could be profitable. Stop loss is not an enemy, but your main protector. It helps you avoid big losses, save your deposit, and keep trading. So set a stop loss on every trade. It is the foundation of disciplined trading and long-term success. However, Even setting a stop loss won't save you if you don't know how to control your emotions. The next mistake we will talk about is emotional trading. This is one of the most difficult problems for beginner traders, and its solution requires not only knowledge, but also work on yourself. At the initial stage, it is really hard to learn how to control your emotions. Each of us wants to earn more, so we overstay in a trade, hoping for more profit, or, on the contrary, after a series of unsuccessful trades, we have a desire to win back. This is a state in which we act impulsively without analyzing, and it is very dangerous. It is important to remember, psychology in trading is important as well as your strategy. If you can't control yourself, even the most profitable strategy will not save you from losses. How to learn to control your emotions? Here are some tips. 1. Trade only according to your plan. Every trade should follow the predetermined rules of your strategy. If you notice that you are about to open a trade on emotion, you should stop. Check if it is in your plan. 2. Set limits for the day. Limit the number of trades or the amount of loss you can afford in a day. For example, if you lose 2 trades in a row, then stop. This will help you avoid impulsive trading. 3. Don't try to win back. After a losing trade, take a pause. Don't open a new trade just to recover your losses. Wait until your mind is clear and return to trading only when you are confident in your actions. Controlling your emotions is what separates successful traders from those who drain their deposits. Every professional trader will tell you that the ability to stay calm and cool is one of the most important components of success. But even with a perfect psychology and strategy, you lose a huge potential for growth if you ignore keeping a trading journal. By ignoring it, you deprive yourself of the ability to analyze your trades and identify the strengths and weaknesses of your trading. Keeping a journal may seem like a waste of time to many, but it is a tool that can turn your mistakes into valuable experience. By recording each trade, you can understand at what times you trade most profitably, which assets bring you the most income, on which assets or timeframes you lose more often, what patterns or approaches work best for you. This data will help you improve your strategy and maximize your profits, as well as avoid repeating past mistakes. To make your trading journal effective, it should include the following points. 1. The date and time of the trade. 2. The assets selected. 3. The type of trade, buy or sell. 4. Reason for entering the trade. It can be a pattern, indicator signal, or news. 5. Entry and exit levels, opening price, closing price, stop loss, and take profit levels. 6. Trade result, profit or loss, in monetary terms or percentage. 7. Your emotions. How did you feel when entering the trade and when closing it? This will help you understand how emotions influence your decisions. 8. Comments and conclusions. What could have been done better? What worked well and what didn't? A trading journal is your personal tool for continuous learning and improvement. Keeping such a journal will help you systematize your trading, discover patterns, and, most importantly, become a more disciplined trader. The last mistake we will talk about is overtrading. Many beginners have a thought in their head. The more trades they make, the more chances for success they have. In fact, this is a huge misconception that can destroy your deposit. Let's say you made $100 in the morning by catching a good market movement. You feel on top of your game, confident in your abilities, and instead of stopping, you continue trading in the afternoon. As a result, the market becomes less predictable. You enter the trade on emotion and lose that $100. The result of the day is zero, although you had a chance to leave with a profit. This example shows that it is better to open one good trade and get away with a profit than to try to squeeze the maximum out of the market. Overtrading not only destroys your overall balance, but also causes emotional burnout. How to deal with overtrading. 1. Set limits on the number of trades. Determine in advance how many trades you are ready to open per day. For example, 2, 3 trades per day is the optimal number for most traders. Have you reached the limit? Close the terminal and do something else. 2. Limit your trading time. Determine for yourself the time intervals in which you trade best. For example, if you are successful in the morning, trade only during that time. Spend the rest of the day analyzing or learning. 3. Monitor your condition. If you feel tired, irritated, or too excited, it is better to take a break. Trading in an emotional state is a direct path to mistakes. Overtrading is a trap that many beginners fall into. Remember that the market is not going anywhere, and you do not have to catch every price movement. 1 or 2 quality trades are enough to achieve your goals. Trading is not a game of chance, but a serious work that requires knowledge, discipline, and analysis. Mistakes are inevitable, especially at the initial stage, but it is the work on them that makes a trader a professional. Learn from your mistakes, analyze trades, and always aim to be better than you were yesterday. Remember, success in trading is not the result of luck, but the result of your work on yourself and constant learning. If you are not ready to understand all the subtleties, or just want to make trading easier, you can use the MiloBot PRO Expert Advisor. It analyzes the market independently, opens trades according to the author's strategy, and does not make common mistakes that beginners make. MiloBot PRO is your reliable trading assistant, which has already helped to increase deposits of many traders. You can find the link to it in the description below this video. If this video was useful for you, please put a like and subscribe to the channel so that you won't miss more valuable trading tips. See you in the next videos.